Okay, let's see. Are we live? Let's get everything going. I might starting these streams off with, like, I don't know, maybe some royalty free music. Okay, it says we are live. Let's see. Pull up, pull up, pull up. Pull up, pull up to class. Make sure you hit that like button on the way in. Make sure you hit that like button on the way in, y'all. So today we got economic indicators. So we're gonna try to basically get through we're gonna get through a chapter. You know, each day I'm gonna at least try to bring one chapter to y'all, so that way y'all can become a lot more informed and actually learn something, instead of, you know, just spending a lot of times in the market, you know, days, weeks, months going by without actually building onto that foundational knowledge that you should be having. So pull in. I'll give it a few minutes before the bell rings. I'll probably give it about 5 minutes to let everybody pull in. Shout out to everybody that came to the live stream before this one. That was pretty dope. We're going to start doing that more often as well. Let's take a look at the prices real quick. So welcome in. Pull up a chair. The markets are rebounding slightly. Share the screen with y'all real quick so y'all can see this as well. Okay, so market's rebounding slightly. We got Bitcoin back at 19,000. Ethereum at 992, still under $1,000. We got BNB still under $200 at 197. These prices, y'all are gonna wish y'all took advantage of these prices. Now, I'm not saying just jump out the window and YOLO right now, but dollar cost averaging into some of these low prices that we're seeing for the first time since December 2020 would not be a bad idea. Now, remember, none of this is financial advice. It's just financial education, financial entertainment, whatever you want to call it. But I definitely believe you should be connecting the dots and tapping in with this information. So Cardano down 6.7% at 45. We got XRP down 4% at 30 cents. Dogecoin at 5 cents, down 7% for the day. In the future, these prices are going to sound absolutely ridiculous. So shout out to y'all that be watching this video in the future. Shiba Inu right now at that 7 level, down 6.17%. Now my prediction is the market can possibly drop further, as you know, we see more, you know, investors get, you know, exhausted, you know, tired from the prices staying down this low. New people coming in, you know, expecting the price to turn around right away, you know, buying the dip here, and it doesn't, you know, give them what they expect, you know, around the first of the month, you know, times where people need to start pulling some money out for bills. We can expect things to drop even further. So we're gonna give it a couple more minutes, about another minute and a half here before we get into this. But make sure y'all pull up, share this stream, so that way those that want to tap in to class and become better informed investors can get this information. Share the stream. Also, I'm gonna be listing in the description section or the comments the name of this book for those that want to get the book and actually follow along. So, Economic Indicators for Dummies. You got to learn, you know, what's going on with the economy, so we can be able to determine, you know, when things will flip, you know, which indicators are giving us signs that, you know, the markets are likely to turn around. That's what this is for. This is for those that are serious about becoming better informed investors. Don't call yourself a better, if you pull up on this video and you just jump out right away, don't call yourself one of the ones that are trying to take this serious, because there is no other place you're going to get this level of information right now during the time that it is absolutely needed most. You don't want to wait until the bull market returns to start trying to pay attention and figuring out what to do then. You want to learn now, so that way you are positioned to get rich when the bull market kicks back in. We already got rich. We did it. If you got rich with me last year, congratulations, but it's time to make more money. So, you know, if you hadn't had your turn yet, then definitely buckle up. But we're going to give it about another minute here before we get into this. So hit that like button. So the name of the book is Economic Indicators for Dummies. It says, learn how to understand how indicators affect stocks, bonds, commodities, and international markets. Use various reports to make investment decisions and also plan strategic goals for business growth. So this is something we definitely want to tap into. This is by Michael Griffiths, MBA, co-author of Trading for Dummies. So, you know, he definitely is a person that is informed. Salute to Kofu Blue for pulling up. Salute to Angry Lion. That's what we're going to do. Drop attendance, man. We're going to take attendance real quick. Who's in attendance? I know it's still kind of early. We got another 30 seconds before we go into the book. But drop, a comment. Let me know if you're in attendance. Also, if you see this later, drop a comment. I will be checking for the comments to see who's all pulling up and paying attention. And, you know, just keeping tabs on who's taking it serious throughout this time period. Because I'm going to know how to respond accordingly to you. You know, if I see you in class versus if I don't see you in class. So drop a comment. Let me know y'all pulled up. Hit the like button. Let's try to keep the likes high on this video. Also, if y'all are sitting through class, make sure when new people come in, y'all let them know to hit the like button. So let's get into this, man. We got chapter 1, introducing economic indicators. So I guess we can keep an eye on the markets while we can let Bitcoin play in the background here while we read this and just follow along with it. Put it on the 1 minute chart. That way we get a little price action going. Okay, here we go. So shout out to Ola, AC Chillin. Shout out to Willia, Rip, Machiavelli. Shout out to Peter Ferraro. Shout out to Ken Mitchell. Shout out to Kofu Blue. This is by Michael Griffiths. Or Michael Griffiths. Okay, so chapter 1, introducing economic indicators. In this chapter, defining economic indicators, looking at what the indicators tell you about the economy, and also figuring out how to track and use indicators to meet your needs. This information is very important, y'all. So let's see, let's get this set up. How can we do this? I guess I could use the microphone. You know what? So everyone has a financial interest in the economy. Although you may not think about it every day. And if y'all got any questions, drop them in the comments as we're moving along. Although you may not think about it every day, your country's economic system has a direct impact on your financial well-being. After all, the economy is made up of you, me, and all of the people who buy products and services. The companies that create those products and services and deliver them to their consumers, the factories and equipment used to make those products, the facilities needed to offer those services, and of course the government. So you see, everyone has an economic role to play. Whether you're a business leader, an employee, an investor, or a consumer, your actions affect the economy, and the economy affects you and your finances. If you're thinking, wow, I should really start paying attention to the economy, you've come to the right place. Economic indicators can help you measure the performance and health of the economy and forecast its future. As a bonus, economic indicators can even help you improve your investment returns, your business plans, and your financial health. This chapter serves as a jumping board into the pool of economic indicators. Here, I give you a basic overview of the topic so you can navigate your way through the rest of this book. So, understanding what economic indicators are, economic indicators. Can you picture NASA's Mission Control Center? Today, it's all flat panels, displays, and subdued lighting. But it used to be a system of big industrial panels with blinking lights, gauges, levers, dials, push buttons, and at least one bright red phone. Each one of those lights and gauges displays some tiny piece of information that was crucial to whatever mission NASA was working on at the time. The economy is a bit like NASA's Mission Control Center. Each economic indicator is a metaphorical dial, light, or gauge that provides information about some part of the economy. One dial shows how many people are working and other shows how many are unemployed. One gauge shows many cars were manufactured last month and another tells how high interest rates have grown. These metaphorical dials and gauges show you what's happening in the economy right now. So remember, although no single mission control center exists for the economy, you can use a collection of economic indicators to see what's happening economically. And although you can't push a button and make the economy change course, at least not by yourself, you and your fellow citizens do have some say about the economy through the purchasing, employment, and other business decisions you make on a daily basis. When you decide to buy a car or not to buy a car, start a business, hire new workers, or even take a new job, you have an effect on the economy. When a lot of people make the same decision and push the same economic buttons, noticeable changes happen in the economy. Economic indicators show you what's happening in the economy. Most indicators examine and report only a tiny slice of the economy, but several of them provide information about the whole economy in one report. By using a combination of both types of indicators, you can tell where the economy has been and where it's headed. So that's very important for us as investors. We need to know, where the economy is heading so that way we get the best returns possible. So, this computer shut up. But, the following sections provide a bit more insight into how to read economic indicators and what they can tell you about the economy. So reading the economy through economic indicators. The economy isn't complicated, but the experts who spend their days studying it have devised their own private jargon to describe it. Unfortunately, their terminology often obscures the economy's simplicity. That's what I mean by, being able to break this information down, learn it, in a way that's simple to consume, because a lot of this, the words they use and things like that can turn people off from it and make it sound a lot more complicated than it actually is. But the economy doesn't have to be confusing. You can use economic indicators to help you read what's happening in the economy. Several types of economic indicators exist. Some record one kind of data, like number of people filing for unemployment insurance, and then tabulate and publish the results. Other survey consumers to see how they're feeling about their financial health. Still, others massage the data they collect using complex mathematical formulas to try and create easy to interpret numerical indexes that represent or indicate the level of things like inflation and consumer confidence. These different indicators are often categorized by their ability to forecast leading indicators. Leading indicators turn up or down before the economy, so they're generally considered to be good forecasting tool. Coincident indicators are useful for identifying the economy's current health, and lagging indicators tell where the economy has been. So let's go over that one more time. Leading indicators turn up or down before the economy, so they're generally considered to be good forecasting tools. Coincident indicators are useful for identifying the economy's current health, and lagging indicators tell where the economy has been. Find out more about economic jargon as it relates to indicators in Chapter 2. There you also find a brief refresher on the math you need to understand to correctly interpret some economic indicators. It's not high-level math, so don't worry if math isn't your strongest subject. Cycling through economic ups and downs. You can use economic indicators to give you a clear picture of what the economy has gone and where it's going. Economic indicators demonstrate when the economy expands, like during economic growth, and when it falls, like in a recession. Economic indicators help identify the following pattern of economic expansion and contraction as it happens over and over again. So at the beginning of an economic recovery, you see an abundance of underutilized production equipment and even some factories that have been idle. A lot of people are looking for work, interest rates are generally low, and the supply of raw materials needed to make new products is high. So let me go over that one more time. Let's go over this one more time. Let me pull this up on the phone just so I can keep up with the comments. Salute. Shout out to everybody for pulling up. Okay, now at the beginning of an economic recovery, You see an abundance of underutilized production equipment and even some factories that have been idle. A lot of people are looking for work, interest rates are generally low, and the supply of raw materials needed to make new products is high. Also, as the economy expands, most people who want a job can find one. Factory equipment is put to good use and idle factories are restarted. Another point, at some point during the expansion, some raw materials become hard to find. For example, say the lumber used for new home construction becomes scarce. The price of lumber goes up as a result, and so do the prices for new homes. As the expansion matures, companies may have a hard time finding the skilled workers they need to continue growing the business. Raw materials and labor scarcity leads to the rising commodity prices and higher wages. So make sure y'all trying to take some notes, just keeping this stuff in mind because this is very important information. Also, economic growth slows down. The Federal Reserve observes the rising prices and the potential for inflation. Sounds like where we're at right now. It responds by raising interest rates. As a result, credit gets more expensive and some people have a harder time qualifying for new mortgages or new car loans. Sales of big ticket items and new home constructions slow down. Sounds very, very familiar right now. It's giving us some type of insight into what's happening. So the economy is still growing. So this is another point. The economy is still growing, but perhaps a little more slowly than before. Employers become cautious. If sales slow, employers slow production. Layoffs may not be imminent, but if sales remain soft, job losses are all but inevitable. Also, another point, the contraction begins. When the nightly news starts featuring stories about rising prices and higher interest rates, people start to worry. Worried consumers hold off on bigger purchases. Instead of flying to an expensive resort, some vacationers take local vacations. Some consumers delay new car purchases as long as their old ones are running fine. The pace of growth may slow so much that the economy actually shrinks. When that happens, businesses are forced to lay off production staff, which causes workers to have less money to spend. Even consumers who are still employees start saving rather than spending. As the economy slows, interest rates fall. Prices for things like houses and raw material also fall. During a recession, the economy takes at least a few months and sometimes much longer to find its footing again. But the good thing is it will do so eventually. Chapter 3 shows the interaction between the stock market, the economic cycle, and the business climate. It also shows the types of indicators that can help investors and business managers plan for the economic future. Identifying what indicators indicate. Though some economic indicators try to report on the big economic picture, most look at only a tiny vignette. For example, one indicator looks at the kind of products people are buying. Another shows its workers are able to find jobs easily. Still, others report on current interest rates, the rate of inflation, and the availability of credit for businesses and consumers. This section looks at the specific types of economic conditions that economic indicators measure and report. Tracking consumer spending. One area economic indicators measure is how much money consumers spend. Consumer purchases drive most of the economy. In fact, if you include the amount of U.S. government spends on behalf of individuals for healthcare, about 70% of all spending is for consumer purchases. Several types of economic indicators focus on consumer spending. Here's what they measure. How much consumers earn. Before consumers can spend anything, they have to earn money. Thus, the strength of the job market is a very good indication of the strength of the economy as a whole. As long as the job market for jobs is robust, the economy is generally growing. A faltering job market is one of the biggest signs that an economic peak is near. I discuss which indicators track employment conditions in Chapter 4. Also, how confident consumers feel. People spend money when they're feeling confident about the future. They hold on to their money when they're concerned about their job or financial situation. The best way to find out how consumers feel about their finances, their jobs, and their economy is to ask them, which is exactly what consumer surveys do. Consumer sentiment is a very good indicator of people's future spending patterns. Turn to Chapter 5 to get the lowdown on consumer economic surveys. Also, how consumers spend their money. Another way to keep up with the economy is to watch consumers' income and spending patterns. Personal income indicators show you how much money people bring home each month. However, the amount of money consumers have to spend isn't a good detriment or determinant on how much they will spend. Sometimes consumers spend more than they make. Other times they choose to spend less than they earn. Watching how consumers actually spend and what they're buying can give you a better overall picture of the economy. For example, if people are feeling uncomfortable about their jobs or if they're worried about the economy, they're probably not going to empty their wallets at the shopping mall. And they're certainly not going to remodel their kitchen or take on a new car loan. Retail sales statistics show you what consumers are actually buying each month and how much they're buying. Turn to chapter 6 to find out how to keep track of both consumer income and spending. So looking at the big picture, the most direct way to evaluate the economy's health is to look at the whole thing and then compare its current condition to the last quarter or the last year. That's exactly what the gross domestic product or the GDP report does. It reports the total value of everything businesses produce and the earnings of both businesses and consumers. The GDP report distills economic data from a wide variety of sources, including other economic indicators, into a single report. In fact, it tries to distill the entirety of the economy into a single number. Then it shows the underlying economic details and extensive data tables to explain how the GDP was determined. Unfortunately, this important report is only available quarterly. Let me see if we got any questions in here. Shout out to everybody for pulling up to the class. Those that are in attendance right now, I can tell y'all that y'all are not playing any games and it will pay off. That's what you must know. This time that you're putting in the gym right now, this does have a ROI. A lot of people think the return on investment is only financial, and it's not. It's also, building a better you, increasing, your understanding in the markets, increasing your confidence. That's another thing that's not tangible. You can't really measure, your confidence, your increasing confidence, but that's something that will come about from this time that y'all are putting in right now. So make sure y'all hit that like button. Salute to y'all. Exactly. So Kofu Blue said, I assume this is why Janet Yellen's opinion, etc., is so important. Exactly. 100%. Can you read off the Liberty Street Economics, the New York Fed DSGE model forecast June 2022? Remind me at the end of the stream and I might do another video and get that out. Real Talk says, will the margin calls be the last catalyst for BTC bottom? Thanks. It definitely is possible. If you look at like CEO Michael Saylor from the company MicroStrategy, they have the most Bitcoin on their balance sheet, and right now they are in. He says that they're they are in danger of being margin called, but he says that they'll just draw up other assets, raise other money from somewhere else to cover the the margin basically. So he says we don't, basically the market doesn't have anything to worry about them becoming liquidated. Which if they did get liquidated, that would absolutely bring the market down. So that's one major catalyst that we definitely want to pay attention to. So that was a good question. But Humble Reminder says, the education is serving me more than making money, so I'll be prepared to make the money. Exactly. Astroverse says, awesome, thanks. So shout out to y'all for pulling up, man. Make sure y'all hit that like button. Also, share this stream. Now, let's get back into this. But when it does come out, it's an excellent indicator for showing the economy's current health. You find everything you need to interpret and use the GDP report in Chapter 7. For another big picture, look at the U.S. economy. Follow the actions and pronouncements from the U.S. Federal Reserve. Y'all always hear me talking about Jerome Powell and the chairman of the Federal Reserve. That's not for no reason. That's because that's who you want to pay attention to, because he's in control, or he's basically the voice of, what would happen with interest rates. So the Fed, that's what those in the know call it, manages the money supply for the United States. Part of its responsibility is to keep inflation from getting out of control. The Fed's reports and actions are very good indications of the economy's current and future condition. Chapter 8 shows you how to keep a close eye on the Fed. This is very important information, y'all. I'm telling you, you walk away from this, this class, and you soak all this game up, you're going to be on fire. You're going to have a much better understanding and know exactly what to do and when to do it. So eyeing manufacturing. Consumer product falls into two broad categories: the things people use or consume every day and the things that are supposed to last for a number of years. In economic jargon, these categories are called consumer staples and consumer durables, respectively, and you can use economic indicators to keep tabs on both. So consumer staples, also called non-durable goods, they include things like food, beverages, toothpaste, medicine, bath soap, paper towels, and cosmetics. Although these purchases make up the largest percentage of consumer product spending, they don't tell you much about the economy. Now we got consumer durable goods. These products include kitchen appliances, laptop computers, home entertainment systems, and even automobiles. These products are rarely urgent purchases. People don't really need a new refrigerator as long as the old one is still working, which is why durable goods purchases are considered discretionary. Durable good purchases show how freely consumers are making discretionary purchases. So if y'all can start to put this picture together, those that have been following along, y'all can see how, this is starting to make sense, how tracking and keeping tabs on some of this information can give you a better idea of what's happening, in the future. So when you look at the economy from the point of view of the durable goods manufacturers, you get an entirely different perspective than from the consumer's perspective. Are orders for cars and refrigerators going up, or are inventories growing? Are the factories having problems getting enough raw materials to keep the factories busy, or is the supply chain meeting requirements? You can watch toothpaste inventories all you want, but the real action is in durable goods. Chapter 9 shows you how to track current sales orders, inventories, and the raw materials supply chain for durable goods manufacturing. Another way to stay up on manufacturing is to ask manufacturers. Business people love to talk about business, which is why business surveys are so compelling and give you an insider's view of the business world. Surveys of manufacturing industries are the most economically sensitive, although you can also find surveys for service industries. If you want to know what's really happening in the world of business, go to chapter 10, where you will find out how to interpret, where you will find out how to find and interpret the premier business survey results. Counting up the numbers of bought, sold, and newly built homes. So this is very important information, moving forward into the housing market. You find another excellent indicator of the economy's health right in your own neighborhood. Have you tried to sell your house lately? Did you have to chase away the buyers, or did your home sit on the market for months or longer? Even if you're not personally in the market to buy or sell a home, housing indicators tell a great deal about the economy's health. Are new homes being built? If so, how many? Are houses selling quickly, or do buyers have the upper hand? Housing indicators are very sensitive to the economy's health. If the economy is doing really well, the housing market is often strong too. In a healthy home building market, home builders can keep a large team of skilled tradesmen and laborers employed in the factories of home building suppliers busy. More to the point, a healthy market for new homes means that consumers are willing to make very large, long-term financial commitments. You can build on your knowledge of the local and national housing markets and stay up to date with housing indicators in Chapter 11. Monitoring inflation. Some indicators also track inflation. The economy almost always has a little inflation, which is a good thing. A little inflation is like an economic fertilizer that keeps the economy growing. However, in this case, the economy is like a houseplant. Too much fertilizer is unhealthy for a houseplant, and too much inflation is unhealthy for the economy. Inflation makes the money you earn worth less, and the prices you pay go up for no good reason. In other words, you see price increases that aren't caused by changes in consumer purchasing habits or the availability of the products. High inflation is the number one concern of bond investors because it erodes the value of a bond's interest payments. As inflation creeps higher, the bond's value falls. Chapter 12 covers the most useful inflation indicators. So let me know who in, check in, tap in. Let me know who's still following along. Salute to everybody pulling up. Shout out to everybody in the comments. Definitely you want to rewatch this stream, to take it in, and take some notes as well. So margin, Kofu Blue says, define margin call for me again. So a margin call is basically when an investor uses funds from the exchange or borrowed funds to make an investment, and the investment has to remain over a certain level or else the investor runs the risk of being what's called receiving a margin call, where the borrower says, hey, if the price falls below this, you have to liquidate this asset in order to protect some of our funds. So that can happen to investors. That's a margin call. So salute. Drop in the comments. Make sure you hit the like button. Share this stream. Also, do your part by getting this stream out. Share it with somebody who you care about and you want them to be in tune with the markets and to have the opportunity to make money when things turn around. So, measuring productivity. Businesses can improve profitability in a couple of ways. They can cut material costs or they can improve productivity. Cutting costs works, but only up to a point. If the manufacturer cuts costs so deeply that doing so harms the product's quality, then the increased profitability will be very short-lived. The better long-term approach is to improve productivity. If the businesses can get more production and more product from the same number of employees, they're basically tapping into free money. They get more product to sell and the per product cost falls. As long as the machinery or employee training needed for productivity improvements costs less than the value of the productivity gains, it is an easy investment for any business to make. As long as the businesses give their employees the tools to produce more and then fairly compensate them for the productivity improvements, everyone is happy. Productivity improvements are as important to the economy as they are to the individual business that's making them. Growing productivity means that the economy can generate more product and profit from the same number of employees. Productivity improvements generally raise the standard of living for everyone and are a good indication of a healthy, growing economy. Chapter 13 explains how different indicators measure productivity and how you can use them. Looking at loans and commodity purchases. Almost everyone borrows money. Consumers use personal credit to purchase goods and services and longer-term credit to buy durable goods. Of course, most homeowners also borrow money to buy their homes. Businesses borrow money too. They use short-term loans to finance things like inventories and accounts receivable, and they use longer-term loans to buy production machinery and finance construction or purchases of factories and office facilities. The interest rates that consumers and businesses pay for short-term loans rise and falls with the economy. Rates generally rise during economic expansion and fall during a recession. One important indicator the economy's health measures the difference between the short-term and long-term interest rates. Short-term rates are normally lower than long-term rates, but when short-term rates get close to long-term rates, you can usually assume the economy is in poor health. Pay attention to that, y'all. Short-term rates are normally lower than long-term rates, but when short-term rates get close to long-term rates, you can usually assume the economy is in poor health. Sometimes short-term rates actually rise above long-term rates, and when that happens, you'll usually see a recession in the near future. To find out more about businesses, finances, and interest rates, see Chapter 14. Sometimes businesses use credit to buy raw materials like oil, corn, wheat, lumber, and even silver and gold that they need to produce consumer and business products. The market call these types of raw materials commodities. You can tell a lot about the economy by watching commodity prices. See Chapter 15 for details. Following worldwide economies. The United States is one of the world's largest exporters, but imports a lot more products from overseas than it exports, which is why the United States has a trade deficit. While exports are a clear boost to the U.S. economy, imports aren't. Check out Chapter 16 to find out how to track foreign trade and trade deficits. Though the United States may be the largest economy in the world, at least for the moment, many other countries have large and important economies too. Not all these countries use the same accepted methodologies for reporting and data gathering as the United States, but you can find enough similarities between them and the U.S. methods that you can use the tools identified in this book to evaluate the economic indicators from other countries. Plus, many of these countries publish their reports in English. Travel over to Chapter 17 to see several examples of first-class economic indicators from foreign lands. Some countries are still trying to establish their economic reputations. These economies are growing rapidly. but they don't always provide the same level of economic information that you find in the United States. Countries like China, India, and Brazil have very large growing economies, but some of their economic reports are hard to interpret. The good news is that their economic reports are improving, and some are even published in English. For the intrepid traveler, these emerging economies offer plenty of investment opportunities. So get your travel documents in order and head to chapter 18, where you find a map for keeping up with the emerging markets. So we got 2 more pages here in this first chapter. Okay, salute to everybody for checking in. Yeah, you got to make sure those notifications on. Crypto Epidemic said didn't know the class started late on the first day, didn't receive a bell. You got to make sure though that notification bell is on, man. The people that are listening to this might even be a course later on. So, you know, most likely it will. So shout out to y'all that tap into the course. So those that are, you know, getting this information for being in class on time when this content is created, you know, you get the benefit of, you know, receiving this value for, you know, free 99. But shout out to everybody for rocking with me. Make sure, you know, y'all are connecting the dots with this information, because, you know, this should be painting the picture, you know, of exactly kind of what's happening in the economy right now, and it should start to, you know, all should start making more sense to you. So salute. I dropped the title in the beginning of the stream. That's why you got to be in class on time, man. I dropped the title. This is by Michael Griffiths. So salute. Salute to everybody that just pulled up. Astroverse says stocks will crash hard due to agriculture, due to fertilizer, hard to come by September this year. Yeah, definitely. I heard a little bit of something about that too. Salute. So shout out to everybody for pulling up. Now let's keep going. So knowing how to start following economic indicators. Hey, I'm really proud of y'all that are tuning into this, because that means y'all are taking this very, very serious. And I'm looking forward to, you know, possibly toasting with y'all, you know, in the future, or, you know, just meeting up, talking about the success that we all achieved, you know, from this information, because this is serious. This is the time right now that a lot of people won't see you putting in that work, but then they'll wonder how you got to where you got. But this is how. So shout out to y'all. But as an investor, I use economic indicators to develop my strategic investment plan. They help me evaluate the risk level in the economy and identify where opportunities may exist. As a stock trader, I use a few additional tools to make specific buy and sell decisions. They're not a secret. See the latest edition of Trading for Dummies, the book I co-authored with Lita Epstein, for an in-depth review of my buy and sell methodology. It's published by John Wiley and Sons Inc. So also, if y'all been following along the channel, I teach y'all several different indicators and, you know, tools to use to identify when to take profits, or, you know, when to enter into a position, to how to follow smart money by using supply and demand zones. So a lot of this information, you can still go through the channel and watch these videos. This information is still there, still fire. You know, it still holds true to this day. So shout out to y'all. Let's keep rocking. But the type of investing I do requires that I check my investments frequently. In fact, I check my investments every day, sometimes a little more frequently, and I evaluate my strategy every week. My weekly checklist looks like this. Now, before we get into his checklist, I want to, you know, note for some of y'all, if you're a long-term investor, you know, then sometimes you don't have to, you know, check as frequently as him. But notice he said as a stock trader, you know, he's a trader. He's somebody who, yes, he's an investor, but he also trades in the meantime. He's not just waiting for years to come like Warren Buffett to eventually, you know, really blow up off the price. You know, he's taking money off the table as the profits are coming in. So keep that in mind. But so here's the checklist. 1, evaluate the current economic situation. Have there been any major change? And ask yourself these questions right now while we read this. Evaluate the current economic situation. Have there been any major changes in the economic situation? Which economic reports have surprised investors? Do I need to adjust my strategy or risk outlook? And, you know, y'all can answer this in the comment sections as well. And 2, evaluate the current condition of the stock market. I analyze stock sectors and the technical condition of the market. 3, evaluate my current investment positions. Have the fundamentals of any of my companies changed? Are any of my existing positions likely to change their technical condition during the next week? 4, evaluate alternative investment candidates. See whether I like to own any stocks other than the ones currently in my portfolio. 5, decide how and when to implement any portfolio changes. Make my plans for how and when to buy or sell. You see how much information goes into, preparing for this. This is how serious y'all need to be taking this. If y'all are not doing this like to this level, not saying you got to do everything exactly step by step, that you hear, but if you're not taking it with this level of severity, you playing, man. You in a way, you one of those people that are throwing your money, to the rest of the market. You putting your money in everyone else's pocket. That's all I'm gonna say. But if any of this is Greek to you, you really need to read Trading for Dummies. It sounds like I'm promoting my other book too much. I'm only doing so to help you understand how I use economic indicators. From my perspective, economic indicators are risk analysis tools. I use them to identify the current state of the market and to predict whether that the condition is likely to change. After all, if the current condition is likely to change, I need to change my investment position. So that's what I always tell y'all, plan your trade and trade your plan. You got to make it, and then come back to it and, determine if you need to revise it, if anything fundamentally has changed. A lot of times when I tell y'all, look at your favorite investments, and if nothing has changed fundamentally about it, then buy more during the dip. Just because the prices, look at Bitcoin having a nice little run right now, but just because the prices, dip down, if nothing has changed about the company, the project, is still solid, then that means you're just getting a better discount. So the following sections help you get started with using economic indicators to meet your investments and business planning needs. They explain how to analyze the economic indicators you choose to follow and how to stay up to date with them so you don't miss anything important, man. This is very, very important. I don't want to hear anybody complaining about money, about losing money, and they weren't in class. I'm gonna just point them right to this class and tell them save it, because this is how you understand where the market is, where it has been and where it is heading. And if you're not trying to find that out and you just want to keep throwing money around and just pray you get lucky, then this ain't for you. So analyzing the data, keeping track of different economic indicators doesn't mean you have to quit your full-time job. You just need to know how to analyze and decipher the data and then put what you learn to use. Let me say that again. Keeping track of different economic indicators doesn't mean you have to quit your full-time job. You just need to know how to analyze and decipher the data and then put what you learn to use. Becoming an economic analyst takes a little practice, but you don't have to spend every minute of every day looking at economic reports to understand what's happening in the economy. I certainly don't. I spend between 30 and 60 minutes each week on this part of my investment plan. 30 to 60 minutes each week. Don't tell me nobody has 30 to 60 minutes in a week. Everybody watching this right now has that type of time available. So you just gotta, find a time and take it serious, and, use the time like this to learn what to look for so you can know how to use this information. So, you may need a little more time, but you may also be able to get by with less, at least after you get a good feel for the analysis process. So y'all are going to be learning the analysis process, why it's so important to subscribe and turn on notifications. So at the beginning, here's a tip. Following all the economic indicators that you think are important to your business or investment strategy may seem following all the economic indicators that you think are important to your business or investment strategy may seem overwhelming. So start small. Select 10 indicators to follow. If 10 prove to be unworkable, start with 2 or 3. Hear me out, y'all. It says select 10 indicators to follow. If 10 prove to be unworkable, start with 2 or 3. Pick the 2 or 3 indicators that you think will be most beneficial to your business or to your investment portfolio. Chapter 9 for details. Then add to your list as you become comfortable with the reports and what they're telling you. So you don't have to, tackle all this at once. You can just, as you learn about them, make note of them, look at the ones that you think are best for you, write them down, start to follow those ones. If you can do 10, do 10. If you can, juggle less, then, like they say, go with 2 or 3. Don't overwhelm yourself. Just get familiar with the process so that way you can start to actually learn. But you have to, put a little stress on the brain to actually grow. It's just like, building muscle. You have to stress, the muscles to actually build, so you got to give the brain a little bit of something to work with so it can actually, feel that it needs to, grow. But see where we are. I recommend that you keep records of the indicators you choose and your thoughts as you read them. Track your analysis over time. Record which indicators cause you to make a specific decision. Remember, I was just talking about that earlier in the live stream. I got my 6-figure trading journal and planner to help y'all, keep track of all the decisions that you're making, to keep track of all the trades, that you're, paying attention to. Y'all can reach out to me to get that book via email, decemberdemarco@gmail.com, or I might pay attention to the students who are that's what I'm gonna do, the students who are most engaged throughout this series, throughout this class series, not just this one, but throughout this entire class series. I might hand that out for free to a few of y'all. So make sure y'all are engaged, and let me know that y'all rocking with it. So let's see. After you've tracked your analysis for a little while, you'll really get the hang of it. You'll find that your analysis is at least as good as the talking heads on TV. And because you've selected specific indicators to suit your business or investments, your analysis will likely be even better than theirs. So what they mean by this, you'll realize how much a lot of people don't even know too much about this information, but by you just becoming versed in it and picking up the basics, you'll have just as much almost knowledge or understanding as the ones you see talking on TV about it. And as you really get more in depth with it, you'll start to see, I think I know a little bit more than some of these people in some of these areas. Like, if y'all seen, some of my videos have actually been picked up by, some of the Wall Street news or websites and things like that for technical analysis. And that's because, this information, especially on the meme coin side with Shiba Inu and things like that, Volt Inu, a lot of people aren't providing this type of technical analysis into these coins. So to see somebody that's doing it, these people are finding that valuable, and they're sharing my videos as well. But shout out to them. But let's see. Soon you'll find that the news reports simply provide too little information to be useful for your analysis efforts. Then you'll be very well on your way to making your own reliable economic forecast. So tracking economic indicator release dates. Keeping up with the economic indicators is fairly easy. Several prominent websites post release dates for the economic reports coming out during the current week. These dates are collectively called the economic calendar, and some of them even include summaries of the indicators after their release. So check out the sites for details. So they got Bloomberg.com listed, MarketWatch.com listed, and Briefing.com. So those are 3 websites y'all can check out. Again, Bloomberg.com, that's BLOOMBERG.com, and then MarketWatch.com and Briefing.com. So when you're first starting out, you may want to rely on 1 or 2 of these calendars to keep track of the indicators you've chosen to follow. However, I've been doing this long enough that I really don't have to use these calendar tools that often. These release dates for the main indicators I follow have become second nature to me. Besides, you can request to have most indicators sent to you by email. Keeping track of the economic indicators published by the U.S. government is especially simple. Here are the 2 primary sources for government indicators. So Economics and Statistics Administration. You can sign up to receive email reports from the Census Bureau and the Bureau of Economic Analysis, including the GDP report, the new residential construction report, the personal income and outlays report, and others. Just go to economicindicators.gov. Also, the Bureau of Labor Statistic News Service. You can sign up for email alerts regarding indicators like the CPI, PPI, Employment Situation Report, and more. Just go to bls.gov/bls/list.htm. So additional sources for email reports are available. Most of the publicly available reports allow you to sign up for automatic emails whenever the report is released. So that's chapter 1 right there. Let's do a summary of that. If y'all got any questions, I really think that chapter did a really good job, just introducing the topic, painting the picture, and just showing the value of how economic indicators can, pay off and how they can be of use. So let me know if y'all got any questions on this, or do y'all want to continue and push into chapter 2, or should we wrap it up here? The class right now is at 48 minutes for this one. Let's see how long chapter 2 is. Because we could potentially just keep it moving and just really, run it up right now. Because it's all going to pay off, You could try to duck the hard work if you want to. But the hard work pays off. And it's really not even hard. It's really easy money if you just, sit back and really listen and pay attention. So let me know what y'all think. Do y'all think we should wrap this one up, or should we push to chapter 2? So shout out to the comments. I definitely see the comments. Earthlings Entertainment said, appreciate you doing this, man. Angry Lion, dude, I'll fly you out to dinner to learn. I'm gonna be having something in Vegas, man, where a lot of my supporters and people that rock with me can come to Vegas and tap in, and we have a event where we learn and also have some fun. So salute to y'all for pulling up. Michi says the price is dropping is a gift. It absolutely is. You have to have a mindset shift and go from thinking and looking at when the prices are falling like, oh my God, it's a terrible time. I'm sitting here drooling over these prices right now. I'm hoping that it goes even further so I can really jump on it. I just don't want to jump too soon and prices fall even further, and then it allows me to get less than I would have been able if I just was a little patient. So you can start the dollar cost average though. That's why I told y'all, if you haven't entered a position yet, you can start very, very small with lunch money, coffee money, something that you don't mind losing, just so you would take advantage of these prices just in case. Now Humble Reminder says, see you all in every meeting. Salute. Shout out to all the channel members as well. Appreciate y'all. These videos eventually will become course material, so shout out to those that's rocking with the course, and those that get the early access for, being, early and pulling up to class. Y'all will get access, but eventually these videos will become for members only or, course students only. So make sure y'all taking advantage of this information. Kofu Blue said, I need to cook dinner for the fam, but please continue for everyone. Okay, tell the fam I said what's up. Urana Viv said, you think she could hit that 1 cent? Eventually in the future, I definitely think she has the possibility to hit 1 cent. We just got an article released that said by like the year 2050, they expect she to almost be at like $5 or something like that. We'll get into that as well. It's really unpredictable. The bear, like CZ, the CEO of Binance, said, bear, there's usually 4-year cycles, 2-year bear market and 2-year bull market. So, it could fall anywhere within that range. But, if we see, us fall into the recession and we see, the Fed steps in and starts to bail everybody out again, start sending out money again, we can see the markets turn around. Okay, so we got 3 people asking for chapter 2 then. Let's get it. So y'all not playing, okay? So we'll just keep this one rolling and push it straight into chapter 2. That's a good way to look at it. Brian Hopgood said, hopefully we got 2 years to accumulate our bags. This is a chance to get rich, y'all. It's not saying you got to go crazy all at one time. The market gave us, remember when, before SHIB really broke out, after it had its first breakout, it gave us 5.5 months to be able to accumulate and add to your SHIB bag. You could have got as rich as you wanted to get if you would have, just took advantage of that downtime. Sometimes it can appear discouraging to invest while you see everything red, but that's just a psychological effect. That's just an effect that they have on you because the candles are red. Think about if it was anything else. If you went grocery shopping and all the prices were at a discount, everything said it was down 60%, 30%, 40%, you would be having a ball. You would be grabbing T-bone steaks, all type of stuff, or if you were going car shopping and all the cars you wanted, brand new models, everything were 60, 40% off. You would be, taking advantage of that. So that's how you should look at these assets. So Bitcoin at 19,045. So let's keep it pushing, man. Salute. Shout out to Angry Lion. Said, okay, I'll hang with you. Dinner can wait. Salute. Yeah, somebody said they ran it. They ran the basically Shiba Inu through an algorithm, like a machine, a program, and it showed that likely by the year 2050, Shiba Inu can be at $5. Now, this was a machine doing these calculations, so, we really can't tell if it'll be accurate or not. We have to just wait and see. But by $5 by 2050, hey, I can do that. You know, because this is for my future anyway. Not saying I won't take profits along the way, but think about it. If it's going to be $5 by 2050, you know, that doesn't mean it's going to take all the way to 2050 until we start seeing some price movement. Imagine what it'll be by, you know, 2030. Come on, man. Y'all got to connect the dots. This is investing. It's not for the weak. But chapter 2. So explaining economic jargon. In this chapter, looking at the main types of economic indicators, we'll also be analyzing the data and making adjustments. We'll be identifying the timelines of different indicators. We'll be considering consensus forecasts and revision reports, as well as figuring out how money and interest rates affect the economy. This is all important information. I don't know where else y'all can get this information like this, you know, in an environment like this. So appreciate y'all for rocking with me. Make sure y'all hit that like button. I can't see where the likes are at right now because I'm looking at the comments through my phone, but make sure those likes are up, man. Kofu Blue said, LOL, I'll be 86. Hey, but guess what? Your kids, they will be straight. And that's not saying we have to wait till we're 86 to experience any joy or any profits or any gains. That's just saying what the price will likely be by 2050. You know, so just keep that in mind. You know, imagine, like I said, imagine by 2030. You know, imagine, you know, where she will be in 2030. That's a lot of money. That's a lot of money. Just keep that in mind. So economists may seem like strange visitors from another planet. After all, they use terms and techniques that are more or less foreign to the rest of us. And they have a seemingly unnatural knack for making accurate forecasts and analysis. But although economists speak in a language all their own with a little effort, you can figure out what they're talking about. After all, if you're going to use economic indicators to improve your investments or business decisions, you need to understand what some basic economic terms like indexes and moving averages mean. This chapter introduces you to the economist lingo, or the economist lingo. It walks you through the nitty-gritty of economic indicators and shows you how to use the work of economists to compare the past to the present and maybe even catch a glimpse of the future. So this is very, very important. This is how it seems like sometimes you can have that crystal ball. Like when I was first, doing technical analysis, and she, that was the first time that I seen anybody really doing that level of technical analysis. And, a lot of people were extremely grateful for that information because it let them know when to buy, when to sell. I can never tell you what to do personally, but, I can show you where the rest of, the people that are investing or traders are likely to take profit. So that way you can, beat them to the punch and, take profit before that point. And it was working out very well for, my followers. So salute to y'all for rocking with me. But, identifying types of economic indicators. As you start your investigations into economic indicators, statistics or reports that describe something about the economy that's generally useful for economic forecasting or analyzing economic performance, you'll find that they come in a remarkable variety. The most common types are tables, surveys, and indexes, all laden with data. This section provides an overview of the majority types of economic reports or indicators. It looks at their strengths and weaknesses as well as their value to investors and business leaders. Summarizing economic results. A lot of economic reports simply report the data in summary tables. These reports tally and categorize the results from the previous week, month, or quarter. Examples of the type of reports including the following: the gross domestic product GDP report. The quarterly GDP report describes the value of all products and services produced in the United States. So I discussed GDP in chapter 7. Unemployment insurance weekly claims report. The U.S. Department of Labor collects unemployment data from every unemployment agency in every state and presents it in this report the following week. I cover unemployment in chapter 4. This is some fire information, y'all. In some cases, just collecting the data can be a gargantuan task. For example, the GDP report collects data from dozens of sources and distills it into a single large report. That all this information is even close to correct is astonishing. The results you find in reports like GDP reports are sometimes adjusted for seasonality or indexed for inflation. Other times the results are annualized to make comparing them with other reports easier. I explain these data adjustments later in this chapter. Surveying for information. You're probably familiar with the concept of a survey, even if you've never participated in one. A typical survey asks a certain number of people what they think about a particular topic. You see surveys used for product preferences tests, consumer satisfaction reports, and political forecasts. Economic surveys ask questions that help you gauge attitudes on economic topics like consumer confidence and the U.S. manufacturing business. Economic surveys are remarkably prescient, I'm not sure how to pronounce that, meaning that they often provide a very good forecast of things to come. For example, when you ask consumers about their finances, you get a sense of their hopes and fears. If people are afraid for their economic futures, they're unlikely to make significant financial commitments, and the economy will suffer as a result. Likewise, when you ask business owners or purchasing managers about their businesses, you get a good feel for how their businesses are doing. If you ask enough business people, you can gain tremendous insight into the economy's future. Examples of economic surveys include the following. So surveys of Consumer Report, several surveys of U.S. consumers like the University of Michigan surveys of Consumer Report ask consumers how they're feeling about their economic future. This survey turns out to be a very good way to predict the future of the whole economy. See Chapter 5 for more on this and other consumer surveys. Also, Manufacturing ISM report on business. Purchasing managers know a great deal about the purchasing habits of their companies and about the sales pipeline. Monthly surveys like the Manufacturing Institute for Supply Management report on business help investors keep abreast of this information or this important economic sector. They also provide an excellent predictor of the future economy. Chapter 10 covers the report on business. The Tankin Survey. Surveys aren't limited to the U.S. consumers and businesses. The Tankin is a wide-range survey of Japanese businesses that asks about their sales channels, inventory, exports, and lending rates. Like the domestic surveys, the Tankin Survey is an excellent forecasting tool for the Japanese economy. See Chapter 17 for details on the Tankin and other worldwide economic indicators. Surveys have to be carefully constructed, or else their results can be misleading. The following sections highlight some issues surveyors must consider. Surveying samples. For a surveyor to offer perfect results, it would have to survey the entire population, or at least a very large part of it. Conducting a survey that big is not only difficult, but also very expensive. To make things more manageable and affordable, surveyors select a small sample of the population to stand in for the whole population. Surveyors can conduct surveys over the phone, on the internet, by mail, or face-to-face. As long as the survey's designers get the sample right, the survey can be a good indicator of the future. See the next section for details on getting the sample right. To make surveys as useful as possible, statisticians have developed tools to help estimate how many people need to be surveyed for you to have some degree of confidence that the survey results are accurate. Generally, the larger the sample, the more confidence you can have in this result. So a lot of y'all know my background is in marketing. So in school, they taught us, about like marketing sample sizes, how you can, basically get a small group of people to, like how they said, to stand in to represent the overall opinion, so instead of let's say if we're talking about a college campus, in order to get a decision on how the campus feels about something, they don't have to, survey the entire school. They might just, survey a certain amount of people from each class and, take maybe, 5 students from, each class or whatever, and put that information together and use that as an overall, determination. And it's something, it'll come to me in a second, but like being able to the amount of confidence, it's called a confidence interval. So like being able to say like I'm within 95% certain that this survey that we ran is accurate, or I think it's like between a 90 and a 95%. You can't ever get like a perfect 100%. So those are like the two confidence intervals right there. So you basically can run a formula that will give you like a standard deviation away from a certain baseline that will let you know how accurate can you basically rely on this survey. So hopefully that makes a little bit more sense for y'all, puts it together a little bit more. But let's go on to this next page. Constructing a valid survey. For the survey results to be meaningful, the survey sample must be made up of people with characteristics that proportionately match the population as a whole. For example, if you're trying to figure out who's going to win a national presidential election and you survey only Democrats or only Republicans, your survey won't produce useful results. You need to survey the right proportion of Republicans, Democrats, and independents, and you need to exclude people who aren't likely to vote. Statisticians use the following concepts to design surveys and to describe the usefulness of their results. So a random sample, although surveyors must design their sample so that its makeup is proportionate to that of the whole population, they must also select their participants randomly. If surveyors hand select participants, the value of the survey result decreases dramatically. And then here's what I was just talking about. They got a note here. It says confidence interval. The confidence interval is a numerical measure used to construct a survey. It describes the likelihood that the actual survey results will be representative of the true survey results you get if you were to survey the whole population. The survey developer uses the confidence interval to determine the number of participants required for the results to be statistically valid. Typically, confidence intervals are 90%, 95%, and 99%. So yeah, I forgot about that 99% one. But the 90 and 95% one, those are the two most popular ones. But a larger confidence interval, 99% compared to 90%, usually requires a larger sample size. So that's why you don't usually see people run the 99% confidence interval, because it would take too much to, get the same. Basically, you could get the same outcome with the 95 or 90. If your goal is to get a yes or no, or just a general what's better, you could do that with the 90 or 95. So margin of error. The margin of error is generally half the width of the confidence interval. Although this is an oversimplification, it's all you need to know for the purpose of this book. For example, if you construct a survey with a 95% confidence interval, the margin of error is 2.5%. If a survey asks people to choose a preference between one product or one candidate and another, and the answers differ by only 1 percentage point, then the result is not statistically significant because it falls within the margin of error. In other words, you can't make a valid conclusion based on this survey result. A larger sample size produces a smaller margin of error. So for more info on any of these concepts, get a copy of Statistics for Dummies. So let me get a couple comments from that. Okay, 40 watching, 46 likes. Shout out to Kofu Blue for keeping up with that. We got a question here. Are any of these economic indicators more important to watch for crypto? So we're going to basically go over, how they all, they all tell us something different in the story that, we're trying to, understand. So you can, after learning about them, you can go through and pick which indicators you like most. Like there's a ton of different indicators that you can use actually on the charts, but you might find some indicators more useful than others, or you just might like the, what certain indicators provide for you over other ones. So, I know a ton of indicators, but I usually on, a quick look only use 3 to 4 indicators, when I'm lining everything up, if I'm doing it, quickly. So, someone else says, shout out to Cuban25, says, hi, says, one question, do you think it's best idea to take coins out of an exchange for now? I definitely think you should have a cold wallet. You should not have all your eggs in one basket. Am I completely against exchanges? No, I'm not. Are there some risks there? Yes, there is. Of course, like we got that update with Coinbase that said, if they were to ever, go bankrupt, basically the money that investors have locked inside of the exchange would be lost. That's a part of, the terms and agreement that you signed on to. So that's one risk that you, have, but you also get the ease of access and trading, when you have them on an exchange, and it's much easier for beginner, investors. So, it's just all about preference. I would definitely, try to spread them out. I wouldn't have it on one exchange, and I would try to use more reputable exchanges than, the lesser known exchanges. So let's keep this going though. But indexing the economy. Indexes are helpful for measuring economic conditions because they allow you to use a single economic statistic to evaluate a large quantity of data. You're probably familiar with the concept of an index because indexes are used so often to describe the performance of the stock market. The Dow Jones Industrial Average Index, the Standard & Poor's S&P 500 Index, and the Nasdaq Composite Index are the famous indexes that track the stock market throughout the trading day. Few people understand exactly what the S&P 500 index is or how it's calculated, but most people know the market is doing well when the S&P 500 index is up and doing badly when it's down. However, just because the S&P 500 index is up doesn't mean that every stock is higher for the day or even that every stock in the S&P 500 is up for the day. The S&P 500 index is simply an average that reports the aggregate performance of a basket of stocks. Although few people treat stock market indexes like traditional economic indicators, they're calculated just like any other index. To create an index, analysts take a large quantity of data and use a formula to turn the data into a single aggregate value that represent all of the data. Examples of economic indexes include the following: Consumer Price Index, otherwise known as the CPI. This baseline index measures price inflation. Check out chapter 12 for the skinny on CPI. PMI, formerly known as the Purchasing Managers Index. This diffusion index measures the strength of U.S. manufacturers. It's created by using the data from Manufacturing ISM Report on Business Survey. I cover PMI in chapter 10. Consumer Confidence Index. This baseline index is based on data gathered in the Conference Board's Consumer Confidence Survey. See chapter 5 for more on this index. What's the difference between baseline and diffusion indexes? Read on to find out. Finding the baseline. A baseline is a reference value and a baseline index. The baseline is a known measure that you can use to compare future or previous index values. The index creators define the period, usually a single year used as the baseline, is somewhat arbitrary, but for most economic indicators, the baseline period is usually within 5 years or so of the current period. A base value is then constructed by collecting data from the baseline period and converting the data into an index value. Baseline indexes allow you to compare large amounts of complex information across long spans of time. You can easily measure the economic results from future years against the baseline years. Specifically, you can use baseline indexes to measure inflation, consumer confidence, and the economy as a whole. Baseline indexes allow you to easily see how fast the measured value is growing. The baseline value, at least for economic indicators, is usually 100. If the baseline index moves from 100 to 110, you know that the index has grown by 10%. If the index reaches 200, the index has doubled or grown by 100%. For the CPI, the baseline value is 100, but instead of representing a single year, the CPI's baseline period spans from 1982 to 1984. In March 2011, the reported CPI value was 223, meaning that the price level had more than doubled since the baseline was established. See chapter 12 for more on CPI. Although economic indexes set the baseline value at 100, any value can be used. For example, in disciplines other than economics, 0 may be used for the baseline. In any case, results above the baseline tell you that the measured value is larger or better than it was in the base year. Results below the baseline tell you that it's smaller or worse. So diffusing information indexes. A diffusion shows how much something has spread away from the center. For example, one survey may ask whether sales orders have increased, decreased, or remain unchanged. The diffusion index shows how far in which direction the answers differ from the unchanged response. You see diffusion indexes most often in conjunction with survey data, but you encounter them in other types of indicators as well. The PMI is an example of a survey-related diffusion index. To see how to calculate a diffusion index, consider the hypothetical survey question of whether sales orders increase, decrease, or remain unchanged. Assume that 100 people were surveyed and 40 said sales increased, 40 said sales didn't change, and 20 said sales decreased. Then follow these steps. So 1, you assign a value of +1 to each of the respondents that said sales increased, a value of 0 to each of the unchanged responses, and a value of -1 to each of the decreased responses. Add the survey results together to create the diffusion index. In this example, the index equals 20. So the diffusion index is +1 times 40 plus 0 times 40, because you remember you're assigning a +1 value to the 40 that said yes, or there was a change or sales increase, and then a value of 0 to the ones that unchanged, and then a -1 to the one that said that they decreased. And that would give you a diffusion index of 20. So take a look at that so y'all can see what that mathematically looks like. Now let's keep going. The diffusion index value is positive or above 0, so you know that sales increased. Sales increases were greater than sales decreases. You don't know the magnitude of the increased sales, but you do know that they increased. In the sales order example, 0 is the midpoint for the diffusion index, but it doesn't always have to be. For instance, some diffusion indexes use 50 as the midpoint. In cases where 50 is the midpoint, the scale is usually 1 to 100. With 50 representing 50%. As long as you understand what the midpoint stands for, its value is immaterial. You can use the methods to calculate a diffusion index, but the basic concept is always the same. The value of the index diffuses away from the center value as more responses favor one answer over the other. So understanding how economists analyze the data. Economic analysts rely on a number of tools to make economic indicators more useful. Having a basic grasp of these tools can help you better understand what the indicators mean and how analysts come up with the data. This section reviews the most common of these analytic tools. Measuring growth. One of the first things any analyst wants to know is how fast the economy or any economic measure is growing. The most common way to look at growth is to use the growth rate, or the percentage growth from one period to the next. Growth rate is a simple tool, and it's as easy to calculate as any percentage calculation. Take a look at the economic results in table 2-1 for the fictional Republic of Fredonia. So just show y'all this table just so y'all can see what it looks like, and then I'll break it down for y'all. So yeah, this is let's look at a couple. Kofu Blue said, wow, easy to understand. Yeah, that's why it's important to go over this information, together. So, it's easier to consume, it's less intimidating, and it just, it's a little more enjoyable to me. So and it also helps, ingrain the information over and over, so that way it just becomes second nature. So from table 2-1, you can see that Fredonia economy grew in 4 out of the 5 years. However, the economy was smaller in 2007 than it was in 2006, which means that the economy declined for that year. The third column, labeled growth, shows the actual amount of growth or decline. In 2010, actual growth was 534,000. The economy grew to 11 million from 10.4 million in the previous year. In this example, the 2010 total shown in table 2-1 is 11,009, but the results in the table for economy and growth columns are reported in thousands of dollars. So the column headings tell you this. So they're letting you know that even when you see a number, when you see something like this that says growth in thousands, then you have to multiply that number by 1,000. So you see it says growth in thousands, but it only gives us $191 right there. But when it says growth in thousands, you have to know automatically to multiply that by 1,000, so you get the accurate the accurate data that they're trying to provide you with. You get that right number. So but the results in the table for the economy and growth columns are reported in thousands of dollars. The column headings tell you this. So you have to multiply 11,009, the 2010 result, by 1,000 to get the actual result of 11.009 million. This reporting technique is very common in economic reports. So they're just giving you a heads up that a lot of times you'll see certain numbers in the reports and it'll say, economy in thousands, or it'll say in millions, or, and you just have to, understand that they're doing that to save space so they don't have to put a million zeros, next to this. So let's keep going. For each economic report you view, make sure you know what the numbers in the report represent itself. If the report says the results are in thousands, multiply each number by 1,000. If the results are in millions, multiply by 1 million. To compare Fredonia's economic performance in 2010 with its performance in the previous year, you may look at the actual growth values. However, using the growth rate is more common. Here's how to calculate the growth rate. So you can do x1 over x2 minus 1 times 100 equals the growth rate. So show y'all this so y'all can see what the actual formula looks like. So I don't know if y'all want to write that down or if you want to, screenshot it or whatever, but take a look at that. And it's just good to, it's not saying you got to master this information right now. It's just good to even know this information. Just by being in attendance of this, you're definitely more informed than a lot of other people. So yeah, make sure y'all hit that like button, share the stream. Let's get this information out. So yeah, we definitely right now in the middle of the crypto class, we're finishing up chapter 2 of economic indicators, just so that way y'all are seriously more informed investors. So in this equation, X represents the data for one period, 1 year. In this example, and X2 represents the data for the previous period, the previous year. So in this equation, X1 represents the data for one period, 1 year in this example, and X2 represents the data for the previous period, the previous year. To calculate the 2010 growth rate from table 2 to 1, use the 2010 data for X and then 29 data for X2 like so. So you can put 1 year over the next year minus 1 times 100. That's how you get that equation or that formula. I'm gonna leave that right there for a second. Let y'all write that down. Okay. Now you can perform this calculation for the remaining years in table 2 to 1. Your results should match the percentages you see in the growth rate column. Then you can compare Fredonia's economic. Let me plug this up. So you can perform this calculation for the remaining years in table 2 to 1. Your results should match the percentages you see in growth rate column. Then you can compare Fredonia's economic growth in 2010 to growth rates from the previous year in table 2 to 1. Calculating growth rates is particularly useful when you're comparing results from recent years with those from long ago, or when you're trying to compare one country's economic growth with that of another country. Using the growth rate puts everything on a common percentage scale. Imagine if you were to compare Fredonia's economic growth with that of the United States. Because the US economy is measured in trillions of dollars rather than millions like Fredonia's, the US number would completely overwhelm Fredonia's. Comparing the two economies by using the growth rate makes these comparisons more useful. So being able to have that percentage, that growth rate percentage, allows you to basically compare the same data, over other countries and say, okay, we know that Fredonia's growth rate over 2009 and 2010 was 5%. So we can look at the growth rate of the United States to determine, in that same time period, the United States was, let's say, 6 to 7%. So now instead of saying the United States had a GDP of trillions of dollars or, whatever, we can just use that percentage to basically make that that determination. So this information is very valuable, man. Hopefully y'all tapping in. So, really soak this up. But using the growth rate, annualizing reported data. Some economic reports provide economic data every week, some every month, and some every quarter. As a result, you often need to compare data from economic reports that are published at different frequencies. Comparing monthly or quarterly data to annual data requires that you convert one set of data to the approximate frequency of the other. The most common way to do so is to adjust all the data so that they approximate the annual results. This technique is called annualizing the data. In other words, you convert the monthly or quarterly data to their approximate annual equivalents. To see what I mean, look at the quarterly report of Fredonia's economy in table 2.2. So here that is right here. So they basically took the quarterly results and multiplied it by, 4 in order to get the annualized rate. Hopefully y'all can see that and it makes sense. So look in the column where it says, it says quarterly results and then annualized. So you can see the quarter percentage. And then you see they dropped it into annualized growth rate. They just basically multiplied it by 4 each number. From the growth rate column to the annualized growth rate column. That's how you annualize rates. So table 2.2 shows the condition of Fredonia's economy at the end of each quarter, along with its quarterly growth rate. If you want to compare the quarterly results with Fredonia's annual results, you need to convert the results to make them comparable. The idea is a little like finding a common denominator when you're dealing with fractions. In this case, you have to convert the quarterly data to its approximate annual equivalent. Fortunately, many economic reports annualize the data for you. For those that don't, the calculation process is fairly simple. You just have to take the results from a monthly or quarterly report and recast them as though they occurred over the span of a year. So to annualize any data set, you need 3 pieces of information. So X1, the result for the most recent period or the ending result for the period you are annualizing. X2, the result for the preceding period or the beginning result for the period you're annualizing. And N, the number of periods per year. For example, if you're looking at quarterly data, the number of periods per year is 4. For monthly data, it's 12. And for weekly data, it's 52. The equation for annualizing data looks similar to the equation for calculating growth rate. The only difference is that you have to raise the fraction by the exponent or power n as shown here. So take a look at this real quick, show y'all this. Shout out to Jay Hire. You welcome. She said, thanks, December. Definitely welcome. Kofu Blue said, can we buy these books on Kindle, etc.? I'm not sure, but most likely they should be available for digital versions. I'm pretty sure. But let's continue. The math for annualizing data isn't terribly difficult, but having a calculator or spreadsheet handy can help you keep everything straight and can make the process go faster. So if you want to use Excel to calculate annualized results, use Excel's power formula. To use year-to-date results, you need to adjust the exponent in the preceding equation. If the year-to-date results are based on monthly data, change the exponent so that n equals 12m, where m is the current month, or 1 for January, 2 for February, and so on. For quarterly year-to-date data, the exponent n equals 4q, where q is the current quarter, 1 for the first quarter, 2 for the second quarter, and so on. So distinguishing between percent, percentage points, and basis points. For those of you with a strong math background, the distinction between percentage change and percentage points is old hat. For everyone else, it can be a source of confusion. So here's a quick refresher. Percent is sometimes called percentage, percentage change, or percentage difference. Percent expresses a number as a fraction of 100. For example, 55% or 55% is equivalent to 55 of 100. 55 divided by 100, which is also equivalent to 0.55. Using percent is a simple way to describe the relationship of one number to another. In the Fredonia example in table 2:1, Fredonia grew from 10.4 million in 2009 to 11 million in 2010. In percentage terms, Fredonia grew 5.10%. Percentage points. While percentage points describe the relationship of one number to another, while percentage describes the relationship of one number to another, Percentage points describe the relationship of one percentage to another. The difference between 4.10% and 5.10% is 1% point. The distinction is important. After all, the percentage difference between 4.1% and 5.1% is 24.3%. The percentage difference calculation is the same as the growth rate calculation. In this case, it's 4.10 divided by 5.10 minus 1 times 100, which would give us 24.39. So basis points, 100 basis points equal 1 percentage point. Basis points are commonly used in discussion about bond interest rates and stock indexes. The difference between 4.1% and 5.1% is 100 basis points. So hopefully that clears up, some things that makes things sound, a lot more easier to understand. We only got a couple more pages here in this chapter, so we're going to get through this. But let's see. Salute to y'all for pulling up. Make sure you hit that like button, share this information. Those that are in this class are serious. The ones that are not getting this type of information, playing. I'm gonna just keep it real with you. I'm gonna ask, those that, complain about certain things. I'm gonna say, where are you in class? And that's all I'm gonna have to say. But smoothing data with moving averages. Sometimes economic data are very volatile. Looking at the data and determining an underlying trend isn't easy. Even if you plot the data on a graph, you may see lots of dots on the chart and no obvious pattern. In fact, the data may appear to be completely random. In such cases, determining what the data are saying is quite difficult. Figure 2.1 shows an example of a volatile data set. It shows a plot of unemployment insurance weekly claims report data. I discussed this indicator in chapter 4. The week-to-week changes in this data series may not show an obvious trend. As you can see from the graph in figure 2.1, the weekly unemployment data are extremely volatile, even when no data are declining. As they are here, it's hard to tell by looking at the graph. Not surprisingly, it's just as hard to tell by looking at the raw data. So here's a graph of the unemployment insurance weekly claims report. Data from the unemployment insurance weekly claims report. So it's showing us a base year of basically 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So basically showing us a yearly, almost year and a half chart of unemployment insurance weekly claims. And we can see a baseline, basically number of weekly claims from 350,000 all the way up to 490,000. So that's what this chart looks like. And y'all don't have to really worry too much about the charts. I'm just trying to show y'all and really expose y'all to this information so you can, be a little more familiar with it and it's less intimidating the next time you hear of it or, run into it. Now, let's keep going. So the most common tool analysts use to deal with the volatility issue is called a moving average. A moving average can help you visualize trends in the data that may not be obvious otherwise. Several types of moving averages exist. I described 2 common ones in this section. So a lot of y'all might be familiar with moving averages from my technical analysis course or, the videos that I went into breaking down some of those indicators for y'all. But we're about to get into it more. So note, many other techniques for weighting and moving averages exist, though economists rarely use them in their analysis. If you'd like to know more about exponential moving averages, check out Trading for Dummies, the book I co-authored with Lita Epstein. So simple moving averages. The simple moving average, SMA, is the most common moving average used for economic data. You can also see it used in other applications like stock chart analysis, and SMA has the advantage of being both simple to calculate and easy to understand. It's a good choice when you need to smooth volatile data. For example, this technique is so common that some economic indicators like the unemployment insurance weekly claims report provide the moving average for you. For others, you have to calculate it yourself. If you were to apply a simple 4-week moving average to the unemployment insurance weekly claims data shown in figure 2-1, the result would look like figure 2-2. So this how it would look if it added that line on there as a simple moving average to show, basically what it's looking like over, I believe I said a 4-week period. Yeah, 4-week moving average. So that's correct. So let's keep going. As you can see, the trend in figure 2.2 is much clearer than the one in figure 2:1. So let's take a look at what they mean by that. You see how in this figure, the data isn't plotted on this side here. The information, all those dots, it's not aligned through it. So it's kind of harder to, you know, identify, you know, what's actually happening. But when they plot it with that 4-week simple moving average, you now get a line that shows you more accurate information of where the price, you know, kind of moved, or where the data, you know, hit the chart at. So until April 2011, the number of people filing claims had been declining steadily. That decline is good news for the unemployed people. However, the jump in April and May is more than a bit worrisome for the economy. Calculating a moving average is simple. To find a 4-week moving average, start with the first 4 weeks of data, add them together, and then divide the sum by 4. So again, calculating a moving average is simple. To find a 4-week moving average, start with the first 4 weeks of data, add them together, and then divide the sum by 4. The result is the first point on your moving average. Then you move 1 week ahead and do the same calculations. For every week of new data that you add to the average, you drop 1 off the oldest week of data. Although doing all the moving average calculations by hand is a bit tiresome, it's really easy in a spreadsheet program like Excel. Use the AutoSum function for the first 4 weeks, divide the results by 4, and then copy the equation for each subsequent week. Exponential moving averages. Another moving average that some analysts find helpful is called the exponential moving average, the EMA. An EMA is a type of weighted moving average. It uses the X value to serve as the weighting factor. Weighting a moving average means that the most recent data receive more importance than the older data. Each new data point is added based on the weighting factor. The importance of each data point is greatest when it's first added. Its importance diminishes over time. To find an EMA, you start the series with a seed value. The seed value can be the first data point in the series, or it can be an average or of the first few data points. So the seed value can be the first data point in the series, or it can be an average of the first few data points. Then you apply the smoothing factor to the seed and add each subsequent data point to the series. The equation looks like this. So I don't want y'all to get too hung up on that. I just want y'all to see what it looks like. Those that possibly want to write it down can write it down, because I know some people like, you know, every bit of information that they can get. And then you can always go back to the video, you know, rewind it and, you know, copy this information. So yesterday and today can stand in for any time period. For example, if the data is weekly, interpret today to mean this week and yesterday to mean last week. The period used to calculate the value X is the moving average period. For example, if you were to use the same 4-week moving average period as you used in the SMA example, the period would be 4 and the value for X would be 2 divided by 4 plus 1, or 2 divided by 5, which equals 0.4. So let me show y'all that right there. Again, don't get too hung up on the mathematics. Just understanding this information is very important. Just being able to understand the overall picture of where this is going. So keep going. We're almost done with this chapter. We got a few pages left. 1, 2, 3, 4, 5, 6, 7. Only 7 pages left with this one, y'all. So let's see. Matter of fact, let me get some questions. If y'all got any questions. Okay, Broski, for you said, do you think the price for BTC is inaccurate? I definitely think the price has the potential to go lower. If you've been following along with the channel, I told y'all I think 17,000 is definitely incoming very, very soon. So let's take a look at this. So let's take a quick look at the price. Let's also see if we can pull up that SMA. So they don't have the simple moving average on here, but they might just have it as moving average. Okay, so they got the moving average here. Now you see how this line, like how we just talked about the moving averages, is basically taking, you know, the average price over these periods of time and plotting it for us. So we can see right now the SMA, our simple moving average price, or our moving average price right now is at 18,834. So we want to like look where we, you know, technically are as an over an average period of time. That's technically where the price should be at. Could it go further? Will it go further? It's likely, very, very much so likely. But that's just something to, you know, pay attention to right now. Any other questions? Let me know if y'all got some questions. I'm gonna give y'all a moment to get those questions in. Drop those questions. You get the chance to ask any questions that you want to ask now. This is information that people normally, you know, pay a lot of money to, you know, find out. Y'all get the chance to ask for free, 100% free. So welcome to those that just pulled up to the crypto class, well, not technically crypto class, but just the class, you know, where we're learning about investing. Okay, so Micah Becker says, what's your most used endos for crypto? So some of my most used indicators are the Bollinger Bands. Number one, I'll say, and this is because it's in alphabetical order, which not all of them are in alphabetical order, but the first one I usually pull up is the Bollinger Bands, because this identifies where the price is trading. Is it expensive or cheap right now for, you know, where it's at? Does the market consider this price cheap or expensive? And by that, we can determine, you know, if we should be buying in. If the price is cheap, then we want to, you know, get in low. This is trading. For those that want to learn how to trade, you learn how to get in low and sell high. You use these two Bollinger Bands to identify the deviation where the price will basically move from the middle, or, you know, how far, you know, basically it'll just stay within this channel basically. Sometimes, like you see right here, it can wick outside of it a little bit. That does happen, but for the most part, you notice how the entire price action stays within these Bollinger Bands. So that's one of the main indicators I use. Also use RSI, our relative strength index. That allows us to know, you know, is the asset oversold or overbought? And we can use that information to determine, you know, when is a good opportunity to buy in. You know, when it's extremely oversold, we can take advantage of that and get in. Once the rest of the market, you know, catches on that the price was actually oversold and they start to buy it up, our price, you know, our gains go up, because we knew before everybody else that it was oversold. Or not before everybody else, but the people that didn't know how to use that indicator. So do you think Bitcoin will end up like Luna? No way. Could it? I highly doubt it. I don't see it happening. I don't even want to entertain that, because I highly, you know, I just don't see Bitcoin evaporating completely, like, or losing 99% or 100% of its value. Too many people would step in and buy too much Bitcoin before it ever went to that. You know, right now people are looking at Bitcoin like an absolute steal. People are loading up right now. People that, you know, bought in at the high prices of 60,000. You know, some of those countries, like I think it was I can't remember exactly. It might have been like Argentina, or yeah, Argentina, I think, possibly. But you know, countries like that bought Bitcoin, you know, actually put it on their country's balance sheet, like they're gonna be averaging down. So if we see Bitcoin hit like something like 15,000, 10,000, especially. Even like, you know, we got some people saying it'll go back down to, you know, 8,000 or 11,000. People are going to be jumping all over Bitcoin at those prices. So let's see. Crypto Epidemic said, I'm enjoying this. Thank you. You're welcome for this. Angry Lion said, still here. Micah said, what should I study outside of class? You can take these books and, you know, and study. And, you know, just dig into these books. You know, we got a couple different books here. So you can, you know, go ahead of the class and, you know, knock some chapters down yourself and then come back and tune in with us, you know, to ask some questions or, you know, share some information. Or you can go into some of the other books. Remember, we got technical analysis here for dummies. We got candlestick charting, demystified. We got financial planning, demystified. We got NFTs for dummies. We got blockchain for dummies, as well as economics for dummies, which is different from economic indicators. Okay, Angry Lion said, maybe not now, but can you explain shorts, longs, margins? So we went over margins as basically borrowed money. Using borrowed money from the exchange to invest into an asset, so that way you get, you know, a better opportunity to make more money. But at the same time, you get a easier chance to get, you know, wiped out or liquidated, what they call it. Once you get a margin call, once the price of the asset falls below a certain price, the borrower has to step in and force you to do a liquidation to protect some of their, you know, funds. And a shorts is basically betting that, you know, the price will go down, and going long is basically betting that the price will go up. Shout out to Dan Strachan, PhD, said, glad you are doing this class. Appreciate you for pulling up on us, bro. Crypto Epidemic said RSI is a good indicator with the Bollinger Bands. Yes, it is. It absolutely is. I made so much money using these indicators in conjunction. And of course, you still have to understand market psychology, because it's not going to ever line up and just be, you know, knocking it out the park 100% just because you understand how to use Bollinger Bands and RSI. It takes a little bit more layering. You know, you got to understand how to wait for confirmations. It's good to understand candlestick patterns as well, you know, and also have, you know, a few other indicators like our MACD as well, the moving average convergence divergence, which helps us know when the price is likely to actually flip. So any more questions before we get back into this? I don't really see Bitcoin going under 10,000 right now, but I really want to look at, we got to look at the charts to, you know, say that, because that's just me really talking. You know, the chart tells us what, you know, is likely to happen. Mark L says, hi, opinion on ETH. Is it still a good buy and HODL for long-term gains with merge? So, you know, this is not financial advice, Mark L, but Ethereum is definitely one of my long-term plays. It's one of my biggest, you know, positions, you know, but you want to be strategic with how you play Ethereum right now. You know, yes, if you're a long-term investor, yes, it's absolutely a good steal to take advantage of, you know, 40% discounts for the week. We were down, you know, 10% today, you know, so to take advantage of 10% discounts on the day, that is a good move to play, especially at these low levels, and if your outlook is for a longer period of time. But if you're one of the short-term traders, you know, who are looking for a quick gain, then you might want to let the price fall, you know, a little bit further. Okay, so now choosing the best moving average to use for your data. Distinctions between an SMA and a EMA are clear. So if you're trying to decide which one to use, consider the following points. The SMA is a true average for the selected time period. For most economic applications, a simple moving average is the more common choice. Just be sure to select the period of the moving average based on your analytic purpose. If you're trying to identify long-running trends, choose a longer period for the moving average. If you're trying to identify turning points in the data, choose a shorter period. A weighted moving average like the EMA tends to react more quickly to recent data changes, but it also has a memory. The EMA doesn't drop any data points, it only diminishes their importance. Analysts often consider the EMA's memory a benefit. However, the EMA's memory also means that the starting seed value always have some impact on the EMA value, even if the seed's impact diminishes over time. If you change the value of the seed, you change the value of the EMA. If the underlying data change because of seasonal or inflation adjustments, the EMA seed will likely change too. When using an EMA, be sure to keep a long-running record of the data and the seed value. Massaging economic data to make the results more useful. Many economic indicators adjust the data before publication. The goal is to make comparisons between current and previous periods more useful. Indexing for inflation and adjusting for seasonality are two of the most common adjustments made. I discuss both in this section. So adjusting for inflation. Economists and most everyone else, for the matter, expect product prices to rise or fall based on the availability of the product. The more product that's available, the lower the cost, at least theoretically. Likewise, when a product becomes more scarce, prices tend to rise. However, when product prices rise because of monetary issues, too many dollars, the rise in price is called price inflation. Inflation causes problems for consumers, investors, and businesses. It also makes economic analysis more important. Most economic analysis use dollar values rather than physical quantities as the basis for economic comparisons. If inflation devalues the dollar, those analysis becomes less useful. So if inflation devalues the dollar, those analyses become less useful, which is why so many economic reports are adjusted for inflation. Analysis can use several different techniques to remove inflation's impact from economic data. This section looks at two of the most popular ones. So indexing for consumer prices. Let's get into that. So you're probably familiar with cost of living adjustments. They're common in government programs like Social Security and Medicare, but you also see them in collective bargaining agreements and some private contracts. Cost of living adjustments help make sure Social Security and other government programs benefits keep pace with rising prices. Where do these adjustments come from? The most commonly used indicator for cost of living adjustments is the Consumer Price Index, or CPI. The value of the CPI is based on the price of a standardized basket of consumer products. In the case of Social Security, the value of the payment owed to beneficiaries is adjusted by the amount that the CPI rises each year. The adjustments are calculated based on the value of the CPI at the end of the third quarter each year. This type of adjustment is formally called a price escalator. In lay terms, it's called indexing for inflation. I discussed the CPI and inflation in detail in chapter 12. So the math for calculating the inflation adjustment is usually straightforward. Just multiply the value to be adjusted by the CPI's growth rate. The result is the adjustment value. Whether you add or subtract the adjustment value depends on the application. For example, if you're adjusting Social Security benefits, you add the adjustment to the benefit. So chaining dollars. For economic analysis, some adjustment techniques are generally better than others at indicating inflation's true economic impact. The most prominently used inflation adjustment for the U.S. economic indicators is called dollar chaining. For dollar chaining, analysts first collect economic data, use current prices, the current market values for products and services, then they separate the economic data into two components, price and quantity. Their goal is to segregate the price components, leaving only a standard value for the quantity of the goods and services. Finally, they express the standard quantity. Their goal is to segregate the price components, leaving only a standard value for the quantity of goods and services. Finally, they express the standard quantity value as an index number based on a reference year that's equal to 100. This approach allows analysts to estimate the quantity change of goods and services separately from annual changes in price. In addition, economists believe this method eliminates the influence of relative price changes, the price of one product relative to the price of another, from the base year calculation. The math is complex, but the end result is a good measure of inflation's current economic impact. The U.S. Bureau of Economic Analysis, the BEA, first adopted the dollar chaining technique in 1996 and has been using it ever since. If you want to find out more about the math used in this technique, check out this link on the BEA website. So you can just look into that. Adjusting for seasonal fluctuations. Some parts of the economy rise and fall with the seasons. For example, retail sales and retail employment are strongest just before the Christmas holiday. Housing construction ramps up in the spring and tapers off during the fall. Fresh fruits and vegetables are most expensive during the winter when fresh produce is scarce. Many economic reports are adjusted to account for these seasonal fluctuations, which are often lumped together and called seasonality. The goal of the seasonal adjustments is to reveal the true strength or weakness of the underlying economic data, without having the seasonal fluctuations obscure the underlying trend. When you remove seasonality, monthly or quarterly results become a whole lot easier to compare. Most reports, such as the Employment Situation Report, provide both the actual data and the data with seasonal adjustments. That way you get to choose which data series you use for analysis. Considering the timelines of economic indicators. Some economic indicators are pretty good fortune tellers. They anticipate what's going to happen in the economy and provide advance warning of coming changes. Others describe the state of the economy as it exists today, and still others tell you where the economy has been. This section looks at these three types of indicators. So leading indicators make forecasts. A leading indicator signals changes before the economy even knows things are changing. Let's say that again. A leading indicator signals changes before the economy even knows things are changing. Some leading indicators are very good at identifying upcoming recessions. Others are very good at showing when a recession is likely to end. It's very important, y'all. Unfortunately, few do both well. Leading indicators aren't perfect oracles. Sometimes they're right, but other times they're wrong. So don't think of them as infallible predictions. Instead, think of them as signs of things that may happen, and then do more research to see if you can find other signs that say the same thing. That's the confirmation we look for. We don't just use one indicator or one, piece of information and make our decision based on that. We're better informed investors. So we layer these indicators, we layer our understanding of fundamentals on top of each other in order to make our decisions. So examples of leading indicators include housing indicators. Home building often precedes economic recovery and decline. The housing market offered one of the early warnings that the economy was in trouble in 2007 and 2008. However, it didn't recover as the economy regained its footing in 2009 and 2010. I discussed housing indicators in Chapter 11. Consumer and business confidence surveys. Surveys are often good economic forecasters. I discussed consumer surveys in Chapter 5 and business surveys in Chapter 10. Remember, these are all leading indicators we're talking about right now. So employment indicators. Declines in employment or increases in unemployment often precede the onset of an economic recession. However, as the economy begins to recover from a recession, employment often lags However, as the economy begins to recover from a recession, employment often lags behind. I go over employment indicators in Chapter 4. So note, although the stock market isn't considered an economic indicator, it does have some predictive power. Stock market indexes like the S&P 500 and the NASDAQ composite have a history of declining before an economic recession and trending higher before an economic recovery. Of course, no indicator is perfect. The stock market forecasts many more recessions than actually occur. So keep that in mind. These indicators are not perfect. You have to use them in conjunction with other, other data to make a good decision. So coincident indicators are no coincidence. Economic indicators that mirror the performance of the economy are called coincident indicators. Although they aren't good for forecasting the economic future, they offer plenty of information about the current economic condition. Now notice how, it's giving future current, and past. Now, when you're able to put all this information together, you're going to be on fire. So examples of coincident indicators include gross domestic product, the GDP. The quarterly GDP report is almost the definition of a coincident indicator. Its purpose is to show how big the current economy is and how fast it's growing. It reports the total value of everything made or sold in the United States. I go over this extensive report in chapter 7. So personal income. Personal income is a part of the personal income and outlays report and is one of the monthly inputs used to calculate GDP. Although consumer spending tends to lead the economy, personal income growth grows and falls along with the economy. So let's read that again. Personal income is a part of the personal income and outlays report and is one of the monthly inputs used to calculate GDP. Although consumer spending tends to lead the economy, personal income grows and falls along with the economy. I discussed personal income in detail in chapter 6. So lagging indicators can't foretell the future. You may be wondering what the point of having a lagging indicator is. After all, a lagging indicator only tells where you've been. Well, that's the point. A lagging indicators are useful to analysts because they confirm that the economy has turned a corner and started to expand or decline. Employment may be the most obvious examples of a lagging indicator, at least part of the time. Though it's very good at identifying when the economy is likely to enter a recession, it's very slow to recover after the economy has started to expand. So employment is both a leading indicator and a lagging indicator. So when it comes to letting us know leading into recession, we can use that the employment as a leading indicator to see, like, when jobs are falling off, we can see that we're typically about to enter into a recession. But it's a lagging indicator when it comes to letting us know when we are coming out of that recession. So looking into the future with consensus forecasts. Forecasting is hard, especially when you're forecasting the future. Whether it's the weather, the stock market, or the economy, telling the future with any degree of accuracy is difficult. That said, people still try. Turn on the business news. Analysts tell you what their favorite stock is going to do tomorrow. Fund managers describe how the market is going to react to the most recently released economic indicator. And economists are always forecasting the economy's growth rate for the coming year. Salute. Make sure y'all hit that like button. Appreciate y'all for pulling up. Shout out to D Nice, Lee Figueroa, Broski for you, Mark L, Crypto Epidemic. Some of the names I just see right there. But the track record for these folks is rather unremarkable. Studies done by the U.S. Federal Reserve show that no forecasters are consistently right. You may as well listen to the weatherman. However, if you take the results from a lot of forecasters and average them together, you may do better than following any single one of them. That's the idea behind consensus forecasts, sometimes called consensus opinions or consensus estimates. They average many individuals' forecasts to create one consensus value. If you want a closer look at consensus forecasting, specifically where some of the more reliable sources are and how to check the accuracy of them, the following sections can help. So, finding consensus forecasts. One of the games investors play is trying to guess the value of upcoming economic reports. Several firms provide private consensus forecasts for a fee. If you're not looking to spend any money, you can find some free consensus forecasts at the following websites. So Bloomberg, MarketWatch, as well as Briefing again. So analyzing the accuracy of the consensus. Consensus forecasting or consensus forecasts are at least somewhat more accurate than most individual forecasts. Although consensus forecasts aren't perfect by any means, they generally outperform any individual's forecast over time. So remember, the caveat is that you still have to give consensus forecasts a lot of leeway, but as long as you understand that the actual result may differ from the consensus estimate by many basis points and sometimes by whole percentage points, the consensus forecast is often your best choice. So see the sidebar. So distinguishing between percentage points and basis points if you're not sure of the difference between basis and percentage points. If your business plans or investment, so we got Bitcoin moving down right now, 18,649, just keeping track on that, keeping an eye on it. But Even if you correctly forecast the upcoming GDP or inflation report, the indicator isn't necessarily a perfect measure of the current economy or a good forecast of the economic future. Play it safe. Use the economic forecast as a guide to adjust your planning, not as the be-all, end-all of your investment. So, use this to adjust, to make revisions, to your strategy, to your plan, or to, help influence your decision making, but don't use it as like, this is it. This is the Bible of decision making. It's not like that. So amending and modifying data with revision reports. Economic data are rarely set in stone. Often, early economic reports are based on incomplete facts. So as new information is collected, the data in previous reports are revised. This type of revision is very common. Another type of revision, called a benchmark revision, has a more significant impact. I go over both these types of revisions in this section. So revising previous reports. The first release of an economic report is commonly identified as a preliminary. When new or missing data are gathered, the preliminary report is revised. Revising is a common occurrence, so you can expect the most economic reports will be revised periodically. Some reports have only minimal revisions based on new data, while other adjustments to preliminary reports can be extensive. In fact, some reports see changes that are significant enough to affect many months or even years of the indicator's previously reported data. Investors and business leaders, as well as economists and policy analysts, regularly make decisions and plans in the face of incomplete information. That's why they want to see the data reports as early as possible, even if those reports will be revised later. After all, something is better than nothing. You can wait for the revised data if you prefer, but most investors and business leaders make portfolio and business decisions based on the earlier reports. They may have to revise their plans when the data are amended, but that's a decision for a later date. Changing benchmarks. People change, buying and spending habits change. Old products become obsolete as new products make their way into the marketplace. Periodically, the agencies responsible for publishing an economic report must re-examine the assumptions they made when they created the report, adjust the methods used to collect the data, or decide to change the report's layout. Adjustments made to take into account these changes in the marketplace are called benchmark revisions. Although all reports may be subject to benchmark revisions, those that are adjusted for seasonality, and especially those that are adjusted for inflation, are more frequently revised. How benchmark revisions work. Benchmark revisions are different from simple data revisions. A benchmark change can modify the structure of the report, reclassify data definitions, or provide new data presentations. For instance, the tables in a report may be updated for newly developed products. Benchmark updates may even require revision to data from previous reports, sometimes causing those reports to undergo significant changes dating back many years. Benchmark adjustments are made periodically to most economic indicators. The frequency of benchmark changes differs by the report. The indicators most affected are surveys based on sample populations. Surveyors need to frequently realign their sample populations with the underlying population to make sure the survey techniques capture statistically valid results. This type of benchmark revision often occurs annually. For example, the Employment Situation Report, which I discussed in Chapter 4, undergoes an annual benchmark revision. The CPI benchmark for seasonal adjustments is also updated every year. See Chapter 12. Other reports schedule benchmark reviews every 5 or 10 years. For analysis, benchmark changes represent both a blessing and a curse. After a benchmark change, some of all historical data must be adjusted to conform to the new benchmark. At best, the adjustment process can be confusing, but it can also help clarify in some situations. For example, in 2009, a benchmark revision for GDP made the 2001 recession look less severe than originally thought. This same revision showed that the 2007-2008 recession was more severe than original estimates. Some benchmark changes can be radical. For example, during the 1997 benchmark exercise, the U.S. Bureau of Economic Analysis converted all of its record keeping from the Standard Industry Classification (SIC) to the North American Industry Classification System. Introducing a new benchmark on the block. The GDP report used to undergo extensive benchmark revisions every 5 years or so. A recent change to the GDP revision process made in 2010 means that the GDP report's benchmarks will be revised much more frequently. The BEA Also, the BEA calls this approach flexible benchmarking. The new flexible benchmark revisions are intended to accompany the traditional annual revisions, but also to more quickly improve the GDP report to more accurately reflect the U.S. economy. These new changes to the GDP may include changes to data definition and presentations, as well as the introduction of new methods for estimating data. You can reasonably expect the BEA to roll out this type of flexible benchmark to their other indicators during the coming years. So, cha-ching, money, interest rates, and the economy. The concept of money shows up throughout this book, so I want to clearly define the concept here. Most people look at the currency in their wallet and consider that to be money. Well, it is, but currency is only one form of money in the U.S. economy. Economists defines money as currency plus some of the deposits at banks and credit unions. In other words, there's a whole lot more money than currency circulating through the economic and banking system. I delve deeper into the money discussion in this section. See chapter 8 for even more info. So, understanding the Fed's monetary measures. Economists use the term demand deposits to describe bank deposits that can be withdrawn without notice to the bank. In the United States, a checking account is an example of a demand deposit, but demand deposits make up only one part of the money supply. Other types of deposits considered in the money supply include money in savings accounts, some money market deposits, traveler's checks, certificates of deposits, and bank deposits with the U.S. Federal Reserve. Note that IRA and other retirement accounts aren't included in the money supply. So drop those comments. Let me know if y'all still are tuned in. Shout out to those that are still in class. We got one page left before we're done with this chapter and we wrap up class. So make sure you leave a comment so I can see those that have been paying attention. I want to keep, marking y'all names down and just, remembering certain names as we go along, because I'm gonna have something, for those that are the most engaged, at the end of this course. So you need to understand the types of values of money to follow some economic indicators, including the FOMC statement and some of the Federal Reserve's actions, which I discussed in Chapter 8. The Federal Reserve tracks and reports money supply values using a language all of its own. The following two categories of money are the most important in terms of economic indicators. So M1. M1 consists of currency held by the public, traveler's checks, and demand deposits at commercial banks, credit unions, and thrift institutions. M2 consists of M1 plus savings accounts, money market accounts, some certificate of deposits, and money market mutual funds. It excludes IRA and other retirement account assets. Setting short and long-term interest rates. Interest rates have a direct impact on the economy's ability to grow. Low rates generally facilitate economic growth, while high rates generally impede growth. That's what we're seeing happening right now. The increase in interest rates is impeding, the inflation, the growth in inflation. So, in general, the marketplace sets interest rates. When businesses and consumers need to borrow money, the interest rate is directly dependent on how much money is currently available to lend and on expectations about future inflation. The longer the term of the loan, the more inflation will affect the interest rate. Consumers with high credit scores and businesses that have a long history of stable cash flow or that can offer significant collateral qualify for the best interest rates on their loans. Those that present a greater default risk are charged higher rates. The U.S. Federal Reserve has some influence over all rates. After all, it controls the value of one very short-term interest rate, the federal funds rate, and it controls how much base money banks must keep in reserve. These controls affect the base rate for all loans. I discussed the federal funds rate in depth in Chapter 8. So that's the end of Chapter 2 right there. We got Chapter 3, understanding the big picture, the economy, and its footprints. So we'll possibly save that either if we do another stream later on tonight, like a late night stream, or possibly for tomorrow. So shout out to everybody in the class still. Let's do an attendance check real quick before we get up out of here, just to know who's all in attendance still. So shout out to Mike King, Washington. Shout out to Micah Becker. Shout out to D Nice, Harlan Fluker, Ola, AC Chillin, Ken Mitchell, Lee Figueroa, Broski for You, Crypto Epidemic, Harlan, Danin Strachan, Libre Pub, Angry Lion, Kofu Blue, Jay Hire, Crypto Epidemic, King Virgo, Earthlings Entertainment, Karen Scott, Cuban 2508, K-Dub1, Brian Hopgood, Your Randoms Vids, Rising Phoenix. Shout out to everybody, man. Appreciate y'all for pulling up. Hit the like button if you haven't. Shout out to Astroverse, Mo Diggity, Blast. Shout out to all y'all, man. Appreciate everybody for pulling up. Shout out to William. Bitcoin, we got it at 18,492, so the price is currently pulling back. We see it is oversold. It's trading along that lower Bollinger Band. It's at the 25 level on the oversold chart. Let's see how far can it go, though. We seen here back in June 2022. Well, basically today, I forgot we're on a 1 minute chart, but earlier today around that might be 8:11 p.m. East Coast time, we seen the oversold point reach all the way down to a level 15. So right now we're at a 24, so we could still expect to see, you know, some more pullback. That could bring us all the way back down again to that 17,000 level with Bitcoin. So we see a run happening right now. It broke outside those Bollinger Bands. When it's trading, when it's sliding just right down that Bollinger Band like that, it can cause a panic sale, and we can see, you know, a mass sell-off, you know, start to happen. But remember, we're on a 1 minute chart, so this is giving us a lot of candles right now. Normally you want to be on like the 4 hour or the 1 hour if you're looking for, you know, more general longer term view. But if you're trading, actually day trading, then you may want to switch time frames, you know, 4 hour, 1 hour, 15 minute, 5 minute, 1 minute, depending on how, you know, close those scalps are that you're taking. Okay, so that's all we got for this video. We're going to wrap this one up. Appreciate everybody for pulling up to the class. Stay tuned. Make sure notifications are on so you can catch the next ones. And we are out.